All right, good day everyone. Welcome to the webinar for today. We're going to look at automated options trading. We're just getting started on time, and I know I always get this question, but I will address it here right away. Yes, it is being recorded, so you will have a chance to look at the recording afterwards if you need to. We're going to talk about a proprietary solution. We can make options trading a bit more accessible, sort of uncomplicate matters. That's the way we like to look at it, using automation and so forth. And we're going to show you that here in just a second. There's people still joining, and we'll go ahead and give it just a second here. In the meantime, let me see if I can get this camera on here. Take a moment. And if not, that's fine too. But okay, I think the camera is working, so this is live. You get to see me at least for a brief moment here, unfortunately. And with that said, let's go ahead and get the show on the road. We're speculating, so we're accepting risk as we try to make money and profit. Of course, with profit, there is always risk. So do look at the risk disclosure. It is important. Remember, the risk of loss in trading can be substantial. All funds committed should be risk capital, and that past performance is no guarantee of future results. A little bit about who we are. We are AltaVest. Been doing this since 1997. We're registered with the CFTC, and we've traded millions and millions of contracts along the way. It's a cool picture. At least I think it's pretty good. That's from several years back on the S&P 500 options pit down on the trading floor with some of our colleagues and floor brokers that worked with us filling our orders. And we've created the Dragonfly strategy. We're going to tell you a bit about that and go through a live demo. And we are registered again with the CFTC, members of the NFA, located in California. And just a bit about myself. I'm Eric Gebhardt. I've been doing this over 30 years now, co-founder of AltaVest. I was licensed back in 1991, and I have my BS in business from the University of Southern California. And I started way back when with the securities and annuities businesses, Series 6, 63 licenses. Now I have my Series 3 and 65 license at the moment. Okay, so we're going to jump into the top 3 barriers as to really based on feedback from our clients. So really as to what gets in the way of our trading. And now that the introductions are out of the way, I'll go ahead and turn off the camera. Gives you a little more room on the screen. Okay. Number 1, noise. So I think we can pretty much relate to this. Everyone's got different price targets and conflicting opinions and all these different choices. And here's like an example of just one expiration for a particular option on the S&P. And we're going to jump into this and how to sort of declutter this in just a bit. And then price predictions, so it's either going to 250,000 or 5,000 next year. And this is from just about a year ago. So anyway, of course, Bitcoin has not done either of those things. And here are price targets for the S&P for 2024, and you can see here that they're all over the map. And of course, there's other institutions with other targets as well, but I'm not sure how valuable any of this is. And how about number 2 in terms of a barrier to trading? Time and discipline and the screen watching. Who has time to do this? Some people, but not a lot. And really, who would want to do that, even if you had the time? And I think this is a fair assessment here of time. Basically, that's really the only thing we have to choose is what to do with our time. A little bit of wise, a wise statement there from The Hobbit. Anyway, so we'd rather be doing things like this with our time, I think. Leisure, and my favorite here sometimes, sleeping. That's kind of a good one to throw in there. But how about number 3 in terms of the barriers? Just really us. We get in our own way with our human emotions. We're not Vulcans like Spock. We ride that emotional roller coaster. We get excited and euphoric as we're winning, and sort of raise that white flag as we maybe are not winning and become despondent, and then start that cycle all over again as things get better. And so we need to try to control our emotions, and that's hopefully what we're going to tell you about here and help you with. And we're going to try to trade options like maybe some of these large institutions do it. So maybe an insurance company is a good example of how they trade, or in fact, how they run business is really kind of how we want to trade. So you get paid premiums to assume risk, you sell time, and you're insuring yourselves, you're hedging your bets, so to speak. You're patient in your process, and you look at math, really, probabilities and the favorable longer term math involved with these positions. And that's really statistics, things like actuarials, number crunching, quantitative data. That's how the insurance companies do it. And we can try to apply that same approach to options trading and collect premium, various strategies where we collect the money. We call these base hits, where you go short or sell options and collect the premium that somebody else is paying you. And of course, you need to be patient as the clock winds down on these positions. You need to manage the risk, and you will have losers. And then manage reward at the same time. Not getting greedy is important too. You'll need experienced people along the way and the correct tools to help you. And that's the software we're going to talk about. So again, not swinging for the fences with these types of trades. Lots of base hits, not grand slams, with premium collection or short option strategies. These are targeted outcomes with fixed maximum risk, and you can use these for any bearish, bullish, or non-directional strategy, or really, I guess you could say, non-directional scenario. And these are called credit spreads. Every position is insured or hedged. Again, predetermined risk and reward. They can be non-directional in nature. And before we jump into the demo, just a quick review of two terms that you probably should know, part of what they call the Greeks in option speak, or options parlance. So determining probabilities, we're going to look at delta. And the definition of that is how much does the option value change with a change in the underlying asset price. And another way to look at that, it's also the approximate probability of expiring in the money. So that's how traders use delta. So if a delta is 0.25, at that moment, there's a 25% chance that it expires in the money. But conversely, a 75% chance of expiring worthless. And remember too, delta is a figure that's always moving. It's dynamic. It moves with price and time. And here, this is important too. It is not the probability of a winning trade. So you cannot look at the delta and say, this is the probability this trade will win or lose. The other Greek is theta, and that's quite simply put time or sensitivity to time. Remember, every option expires at some point. And so theta is really time or time decay. A negative number equals 1 day of time decay. So if your option premium's at 10 points, the theta is negative 0.05 in this example, and then that means the next day, all things remaining equal, the premium would slip to 9.95, and then the next day after that, 9.90, and so forth as time ticks away. And this is what it might look like on a graph as you approach time zero. And this could be any time frame. These could be 9 days, or it could be 9 hours or months. But as you get closer to that end point, the percentage of the premium remaining, or the time value, drops and drops and drops. Eventually, every option expires. So we'll look at what Wall Street pros do. They trade these multi-leg option strategies or spreads, and they often collect premium. Here's this woman on CNBC, and I quote her later if you want to make a note of who that is, but she's absolutely correct here in what she talks about. She said an option spread is buying and selling different contracts, a common way for investors to hedge risk and volatility. It's usually a cheaper way to trade because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. So we're going to talk a bit more about that, but in the meantime, one of those barriers we talked about were emotions, our own emotions, and how do we as people compete with the systematic trading and all of the machine trading that's going on? This is our competition in the landscape right now, whether we want to believe it or not. I mean, you see these moves day by day, and it's just not people like us sitting behind their desk buying and selling. This is machine-driven stuff, algo-driven stuff. It's all money flow and quantitative driven for the most part. So automation, built-in controls. JP Morgan estimates systematic trading is over 90% of US equity trading volume. So that's really quite dominant, to say the least. So what about algos used for these option spreads that we talked about? So yes, that's how we like to look at things, is using the math and the algorithms to help us along our way as we make these options trades, and using automation to collect premium. We're going to look at some of these strategies here in our demo in just a second. And here's a couple of examples before we jump into the live demo. Here's the E-mini S&P 500 call spread. Here's an example. You would use it if you're bearish or even moderately bullish, or completely indifferent in terms of non-directional. Maybe you think the market will be choppy. So here's an example. The red line here represents the call that you're selling. The blue line represents the call that you would be buying simultaneously. You do this at the same time as one order or one net price. So you would sell that 49.30 call, you collect 4.5 points, you put that in your pocket. At the same time, you buy the higher strike and you pay out 2.25. And the net result is you collect 2.25 points, or $112.50. And it's $50 a point on the E-mini S&P 500. And of course, minus any commissions and fees. So that's just an example of what it looks like. You're selling an out of the money call spread and collecting net premium. And then here's an example of a put spread. You would do this if you're selling a put spread if you're either bullish, moderately bearish, or even non-directional. And again, here's the out of the money put spread. You might be selling the 42.30 put, you collect 3 points. The 42.10 put, you pay out 1 point. And the net result is you collect $100 on that one position. All right, and then just a reminder too, these are not naked strategies. These are all covered strategies. Everything is predetermined. That's why we do this. These are called covered spreads. No naked trading allowed, folks. And a couple big advantages: no unlimited risk, and then no margin calls. And that's a really important point. I think a lot of people miss if they're trading naked options somewhere. You're guaranteed to end up on a margin call at some point if you do it long enough. So you don't want to end up like this poor guy here. It looks like his wife or girlfriend is saying to him, "Who is Margin and why does she keep calling you?" So I thought that was a good joke. Anyway, little trading humor there. Here's a condor called an iron condor spread. It's really just a combination of the put and the call spread that we just saw. And this is what it would look like. You sell an out of the money call spread and sell an out of the money put spread at the same time. You do that simultaneously. So there's 4 different strike prices. So you can see here, you buy this call, you sell this call, and you collect the net premium. And then the same thing with the puts. You sell this put, and then you buy this put, and you collect the net premium. And these are covered spreads. For every short option, there's a long option. And it's a non-directional type of strategy, something that we think is worthwhile. And remember, theta decay reduces the spread value, and the intent is to exit the spread by buying it back for less than what you received. So for example, here you see the market was trading, kind of went lower to sideways, and then in this case, we'll look at this in a minute, but when this turns blue, that means take profits and you buy back the spread. So maybe you sold it for 2 points and you bought it back for half a point. And that's the idea behind trading an iron condor spread. And then here's this weird strategy. People have called it weird. We think it's a compliment. It's called a dragonfly, something we created years ago. It has 6 legs, and it's a variation on the iron condor strategy. And it's non-directional. And here's what it looks like. We'll go over this in just more detail here, but Every call side of the position and put side of the position will kind of have the same general structure where you sell 4 calls, you buy 3 further out of the money calls, and then you buy 1 closer to the money call. And the same with the puts. You sell 4, then you buy 3 further out and 1 closer to the money. And you collect the net premium on the put side of the trade and the call side of the trade. And then, of course, as theta decay works its magic, hopefully you can then buy that spread back in the near future for less than what you received. So you can see again in this example, the market kind of went a little bit lower, chopped around a bit, and then this is the point in which we got this blue signal that says to take profits, and then you were able to buy it back for less than what you originally received for it. And that's the idea behind these types of strategies. And there's our unique bullish and bearish option strategies too that we can apply to any type of outlook that you might have. But we just looked at really more non-directional strategies right there. But I don't want you to think that's all we can do. And I'll show you in just a second. But really the big question people have is, where do you even start with building a spread? You know, which strategies to apply, which strikes to use, which expirations, at what price, you know, your entry point, your timing. And then once you're in it, how do you manage the risk and the reward? And that's what ThetaTrader does. So ThetaTrader will pre-build these option strategies for us with our algorithm. Every day there's a menu of theta trades available for all market conditions, and then something called the RTI, that's the risk thermal indicator, and that's our color-coded indicator to give you a signal to get out of a trade, whether it hits a profit target or a risk target, whichever happens first. Okay, and we're going to jump into the demo. It'll take me just a second to switch screens here. All right, you are now looking at the dashboard for ThetaTrader, and you'll notice this is just a demo account, by the way. So yours would look very, very similar, but it wouldn't have necessarily all of those menu items up top. But it would look like this here. You have a section for theta trades. In fact, let me do this. Let me magnify the screen just a little bit. Is that better, folks? I know I don't like watching things and squinting, trying to look at all the details, but here we go. So you have your theta trades up here, any open short positions, any open long or bought positions. You have your account information here. It's all integrated with your AltaVest trading account. And ThetaTrader is the AltaVest technology that we developed for our clients. So you would have a trading account with AltaVest. Then you have your current prices here. So it's a very simple, user-friendly, intuitive outlook here, or landscape and interface. And you'll notice there are bullish strategies that are pre-populated, bearish strategies, and then neutral or non-directional. And then the markets we trade, these 3 markets that we favor, and I'll tell you why in a little bit more detail later, but the bottom line is that's where all the volume and liquidity is. So that's really why. But that's the E-mini, S&P 500, NASDAQ 100, and Russell 2000 mini contracts. And why don't we look at, since we looked at condors, and I'll explain all these color codes, these colors in just a moment too. But we did look at condors. We will take a peek at today's theta trades for condors. You can see days till expiration anywhere from 22 to 65 days. The algorithm has selected these, put those together in that menu for you so you can take a look at those. And I always, just for the sake of the webinar, pick the one with the most days till expiration. And you can see the strike prices are pre-selected. This is the March end of month expiration. Let me just give it a second here. It's pulling up the data and kind of getting all the details for us, the nitty-gritty details. So the first thing I like to do before looking at all of this is look at a graph. Here's the call spread that you're selling, and here's the put spread you're selling, and here's the current price. So that's what it looks like. And you can see the, well, let's just call it the wide margin of error. So you have the calls way out of the money here that you're selling, and the puts that are far out of the money that you're selling. You'll notice there's the expiration date here, the settlement value, the net premium, your put risk, call risk, your commission, available capital, cash required. And let me do this real quick. Might be a data glitch on this. Let me look at this other one real quickly, just to see if I get the numbers I need on that graph. This is the week 3 expiration. There were just a couple things I wanted to point out. Yeah, for some reason it could be, let me look at this here. And if we don't get the numbers I need right away, it's not important. I'll show you a little bit later what I was referring to. Okay, it's not important right now, but I was going to point out a couple different numbers, but we'll just go back to where we were on this March into month expiration. Sometimes on these webinars, the data feed somehow is slower than normal, but anyway. So this would be your profit potential at expiration, targeted return on cash, and your targeted annualized return. So that's all. That's what those numbers mean. And you can see the strike prices are pre-selected or pre-populated. Now you notice here the calls and the puts that you're buying and selling. So here's the put that you're selling, the 4510 put. It has a delta of 9.29. And remember what the delta means. That's over a 90% probability that this option would expire out of the money. And the call that you're selling here, 5.23% delta. So you're looking at, over a 94% probability that this call that you're selling to someone else would expire out of the money. All right, and then we want to make sure that we're selling that particular, oh, there we go, I'm sorry. I had the, well, it's a finer point, but it was my mistake, folks. These numbers here are correct. It's just that I had mistakenly chosen to buy the condor, not sell it. So now that I've corrected my mistake, I'll point this out. Your maximum profit potential at expiration, targeted return on cash, and then your targeted annualized return at expiration. So that's what those numbers mean there. And I'll show you, we can compare the condor to the dragonfly. And that's really what was most important there. But otherwise, none of the deltas change. And because we're selling the condor, again, if I confused anyone, you're selling this out of the money call and selling this out of the money put and collecting a net premium. And then just to be clear, you're hoping the market stays, basically in this range between this area here, and then you can buy it back for less than what you paid, received for it. So we'll go ahead and sell. We'll just choose 4 of these. We'll leave the price alone and we'll place that order. And there it is. Just assumed you're filled because we're doing the demo. So you sold those 4 iron condors, just that simply. Now let's go back to the dashboard and we're going to jump in and look at a dragonfly. Okay, so we've got the neutral tab, dragonfly. We'll look at the March into the month. Same expiration that we looked at just a minute ago on the condor. Okay, so here's a graph of the dragonfly. In this particular case, here's the call side of the trade, and here's the put side of the trade. And you'll notice that you're selling these 52.75 calls and you're buying one of the 52.25. So that's 50 points closer to the money compared to the 4 that you're selling. And you really have that same structure on the puts. You're selling these 4 puts, and the one that you buy here is 50 points closer to the money. So that's the difference in terms of the structure. The big difference is that you own this call and you own this put that are 50 points closer to the money compared to the 4 that you're selling here and the 4 that you're selling here. So that changes the risk reward a bit compared to the condor. So it's a little bit less aggressive. It has less profit potential than a condor, but it tends to be more robust in terms of staying power. And I'll show you that in a couple of examples. But the same type of thing here. You've got your expirations, settlement value. So you're collecting $365. So you're always collecting more money with a dragonfly, and that's because you're selling 4 calls and 4 puts, not just 1 call and 1 put. And this is per dragonfly. And your cash required here, just under $5,000 per dragonfly. Your maximum profit potential, targeted return on cash, and your targeted annualized return. So these will always be a little bit lower compared to a condor if you have the same expiration. And you'll notice the delta on the ones that you're selling here and the ones that you're selling here. Again, over 90% probability and 94% probability that those options would expire worthless or out of the money. Defaults to a sell, and we'll do 2 of these, and we'll try to collect 7.3 on those. And of course, it's a demo, so just automatically assumes that you are filled. So it's just that easy to use the algorithm and the pre-built structure of these trades, and then place those trades and let ThetaTrader get those orders filled for you. All right, now let me show you really a great feature, and we can dig a little bit deeper into the difference between the condor and the dragonfly. And we have under here, there's a trade simulator. You can go backwards in time, sort of like a time machine for trading. And I've loaded a couple of trades here. I'm trying to remember what I did, but let's just play it and see what happens. So you can use these buttons to go step by step, 1 day at a time. And you can see each day going past. You can go backwards in time, you can go right to the end, or use the play button. And just to review, this is a September end of month Iron Condor. And the first day here we're looking at is August 1st. The trade had 60 days till expiration when it started. And you can see the P&L starts out negative because theta decay hasn't started to work yet. Now you can see the green RTI. That means good, do nothing. Just let the time keep ticking. You can see it turns yellow. That means elevated risk, but still do nothing. You can see why, because it's starting to drop a bit quickly here, getting closer to the lower boundary of the put spread that you've sold. So the risk is increasing on the put side of that trade. Then it goes green again, so do nothing. Then it turns green here. Your P&L is getting profitable. So all is well. You can just basically look at the market kind of chopping around. And then it turns blue, and blue means take profits. The algorithm says this is the time on this day to take profits. And what you can do is automate this so that whenever it turns blue, ThetaTrader is scanning the account and it will place that order for you automatically. So you do not need to screen watch and be glued to ThetaTrader in order to have a profit-taking order submitted on your behalf. Okay, so that was on September 14 with 16 days left. The algorithm says get out, take your profit, and run. So let's compare that to a dragonfly. This is the same day, August 1st, for the end of month expiration. So instead of a condor, what if you had done a dragonfly? Well, it's kind of looking similar, isn't it? You get the yellow because the market's dropping, obviously, doing the same thing. And then here you go. On September 14, it turns blue, and you get a profit-taking signal. So in this case, the dragonfly and the condor had an equivalent outcome in terms of how long you were in that trade. They both worked out and did just fine. Now let's point out another simulation here. This is June 28 on a condor, and we'll compare that to a dragonfly. It gets yellow and then it gets orange. That's even higher risk, but still do nothing. You can see why, because it sort of quickly ran out of the gate and went upwards closer to the boundary here on that short call spread, but still do nothing. And it goes green again, and then it turns blue. So you take profits on August 11, according to the blue RTI. So make a note of that, August 11 for the condor. So here is the same expiration. Instead of a condor, we're doing a dragonfly. Let's see if there's a difference here. Look at that. On August 4, you get a profit-taking signal. So basically, a week earlier compared to the condor, you would have a profit-taking signal to close out your dragonfly, take your margin, and move on to another trade. So you can see how the dragonfly in this case matured more quickly and allowed you to get out of your position favorably earlier. And I'll point out why. It's because, again, you own this call option here that you bought, the 46.50 call. You bought that call, and it's 50 points closer to the money compared to the ones that you sold. So it gains in value more rapidly because the delta is higher. So in this case, it helps you by creating more value in the trade so that you could actually close it out more quickly compared to the condor. All right, so here's another example. This is from November 29th. Here's a condor. And I actually kind of forgot what happens here, but it's getting real close to the upper boundary, turning orange, but still do nothing. You know, I want to point out something too. If you were doing this by yourself without any guidance of any kind, you'd be kind of chewing your nails because you wouldn't really know, or probably would have a hard time figuring out what to do with this trade at this point. You know, you can see that the risk is increasing, it's getting closer to your boundary. But that's what's nice about having the color-coded signals here to help you make some decisions. And it's getting more elevated, and then that's where it is right now. So this trade may or may not work out, hard to know, but that's where it is right now, this condor. And now let's look at a dragonfly placed on the same day, same expiration, the end of month January contract, or January expiration, I should say. But look at that. You actually had a profit-taking signal on the 17th, you know, over, well, a week ago. So the dragonfly, again, was more robust, allowed you to actually take a profit on the position and move on to the next trade. And had you been in the equivalent iron condor, you'd still be in there and it'd be under pressure. So that's the big difference between the dragonfly and the condor, where the dragonfly is going to generate, you know, more likely, here, I'll just give you an example here, less profitable opportunities, but there will be times where it's more risk averse and more robust in terms of handling the risk, and it will give you opportunities to get out either for a profit or get out earlier for a profit compared to a condor. So it's just it's not that one is always better than the other. It's just that you know, here's the targeted return on cash is just about 6% on that dragonfly, and the targeted return on cash for the condor, we're just looking at today's March end of month, hopefully I'm making sense here, folks. I just want to give you an example here of today. Targeted return on cash is just over 8%. So a difference between the condor, 8.28% compared to about 6% on the dragonfly. But you give up a little profit potential on dragonfly, and in exchange, you have a position that can sometimes be more risk averse compared to the condor. So that's why I'm just pointing that out. Now, there are bearish strategies that are pre-populated, There are bullish strategies as well. And I also want to point out that, I'll just give you an example. You can go back and use the simulator, and you can go back in time and choose any market and any strategy. And I won't spend the time doing that, but just want to show you how it works. You just choose what you want here, choose the market, choose the strategy. I can explain this bull hedge later, and then you can go back in time, how would it have done, starting here to here, and then you press that, and then you get that chart and go back in time. So that's how easy it is to do that. But I also want to point out what ThetaTrader offers is proprietary research. We do this each day for clients with our TradeScope newsletter. Here's an example of the recent TradeScope here. And then also, there's daily commentary on the markets with the economic outlook, what happened in Asia, in Europe, in the US, and then looking ahead, and then any of the economic calendar. So that's all available. And then this is a really great feature under my account. You go to the help file, and then this, for example, will explain all of the color coding for the RTI. We're not going to go into all the detail there, but then all the strategy definitions. So it's all right here. That's a very useful section. And then there's also videos. There's a whole sequence of videos where you can review all the different strategies, and you can see here how to place the trades, education, if you need to review something on how this or that strategy works. It's all available right here. Now, I also want to point out in the account settings, this is where you would go to activate your risk manager. You check that button and activate the profit directive. And so that's how the RTI then would automatically submit orders for you when it turns blue or when it turns red. And then you would just save those settings. So that's how that works. And then going back to the dashboard, you can look at closed positions all on one page if you'd like. So you can see a history of your trading. So you can see here, 13 trades. There are the short positions, the bought positions. This is just a demo account. I wouldn't make, sometimes these are all like 100% profitable. It's crazy. On other times, of course, there's losses in there, and it's just a demo account that I use for these, so I wouldn't make much of it. But here's an example of, let's say, here, let's highlight this dragonfly. So I clicked on it. You can see it's gray and highlighted, and you scroll down, and here's what this trade looked like when you first placed it on November 30, if you had placed it on November 30. You can see it's actually red or unprofitable for a while, and you can see sort of why. The market's moving higher and higher, getting closer to your short calls here. But ThetaTrader and the algorithm said stay with it, and then it starts turning yellow and then green, which is good, and the trade's now becoming profitable. And then it turned blue here with 15 days, and place an order to close out the trade and take the profits. So that's just kind of going back in time, looking at your closed positions. You can see all of your open positions here on this one page, as well as the dashboard that we saw, the home page, so to speak. Make it easy for you. All right, so there is a good rundown of ThetaTrader in the live demonstration. Let me show you one feature here that you're going to absolutely love, and I think it's probably the best feature of all. So here's the open positions all in one spot. In fact, let me do something here. I think we're doing okay on time. Before I rush off into the next, perhaps best feature of all, let me go back to the Theta trades. And I will point out a couple positions where maybe you're bullish on the NASDAQ. And here's something called a bull hedge. And we kind of came up with that name, and I'll show you what it looks like here. But you can do a bull hedge on the S&P 500, NASDAQ, or Russell. And really, it's a combination of a put and call spread. And here's what it looks like. Let me expand the screen here. So you would buy an out of the money call spread and you pay money for that, but at the same time you sell an out of the money put spread and you receive money for that. So you can use the money that you receive for selling the put spread to pay for the call spread. You can typically do these at a cost of zero or even a net credit. So that's what it looks like on the chart. Just wanted to point out to you that we're not just always non-directional in nature. If you're bullish, or you could just easily be bearish, and you can do the inverse of a bull hedge as the bear hedge. And we'll go ahead and just do well, how about we'll do 3 of these there. So you can see the 3 calls that you bought, 3 call spreads that you bought. So if the market moves higher, these will gain in value, and then the 3 put spreads that you sold. And if the market moves higher or stays the same, then those will decrease in value, and then you could buy them back for less than what you sold them for. So just wanted to point out that really it's multidimensional. Sort of you can use the algorithm and fit it to your outlook, whether you're bullish or bearish or non-directional. A lot of different opportunities here. So just wanted to point that out. Now, give me just 1 second, folks. I'm going to change screens, and we're going to look at what I think is probably the best feature of all. And I do see some questions coming in, so keep those coming. I'll get to them. I might answer them as we go. These are the one-touch responsive trade alerts. So I'm going to show you that here. So this is an example of what a trade alert might look like on your computer, your phone, your iPad. You get a graph of the trade. You get the details of the trade, a little introduction to what that trade is. So here's what it looks like. You get it on your phone like that, and all you have to do is touch accept or reject. That's all you have to do. So it's not just an email that you have to then log in to place the order for yourself. It's already teed up for you, so to speak. So these are live alerts, meaning they're integrated with your AltaVest trading account. So you just touch accept to place the order, or of course reject. So here's what it looks like, folks. We have added a couple different features, but it basically looks the same. I know it's just a couple years old, but you get the graph there, a little headline, but you can see this is a condor. You're selling this out of the money call spread, and then you're selling the out of the money put spread. I want to point out that the net premium is already calculated for you, the cash required. And then look at this. This is important. The quantity is pre-selected. So every alert that you would receive is customized and tailored for you and your account. So it takes into account what positions you might already have in your account and how much capital you have in your account. And you can see it gives you the trade, shows you the targeted annualized return, 71 days till expiration. And then if you like the order and you want to place it, you just accept it. So it's no different than having a broker call you, for example, and saying, we recommend XYZ, and you say yes or no. We're just doing this digitally, and we'll make one more run through here. So it is that simple, and it could be a bear hedge, a bull hedge, buying call spreads, selling a condor, selling a dragonfly. It could be anything. So there you have it, folks. You don't always have to rely on going to the dashboard and selecting the trades. You'll get these trade alerts as well. So here's what you get, folks, if you want to get involved with us. We have a membership, our ThetaTrader membership. You get all of the software that we just reviewed. So all of the theta trades, the risk thermal indicators, so the automated risk and profit controls, and then you have that trade simulator, so you can go back testing with the option spreads and That value is over $3,500. And then of course you have the trade alerts that we just saw. We just did that video demo there. Again, those alerts are integrated and live with your trading account. You touch accept and it's all handled for you. Those orders are placed on your behalf. Over $4,400 value on those trade alerts. And then ThetaTrader and the alerts valued over $8,000. And then you have private coaching. So that's probably what makes us much more distinct than a lot of other services that are really probably online only. We're actual real people with licenses, registered in the business for decades, experienced. So we'll share our screens with you, give you any guidance, talk to you about your trades, whatever it may be, whatever's on your mind. You have a co-pilot, and really that's sort of invaluable. I know there are educational services and firms that are all good and well, and they're charging $20,000, $25,000. There are systems out there that are $50,000, easily valued at $7,500 to have us on your side. So you have the ThetaTrader software that includes the alerts and the private coaching, valued over $15,500. And then allow me to get a little corny. You know how they always say on those infomercials, but wait, there's more. I just don't want you to forget, folks, our proprietary research, help keep you informed. It's only available to our AltaVest clients, valued over $2,900. We have those online video tutorials I mentioned as well. That's just part of the ThetaTrader package. So again, to summarize, you get everything we talked about: ThetaTrader, the Theta trades, the alerts, the private coaching, all of the proprietary research, $18,504 value. But of course, to get even more corny, we're not going to charge you that. And we did offer this at $4,000 for many years in live events, in-person events. We do seminars and so forth. But of course, we're doing this basically remotely here online, so we can offer a much, much better deal for you, so to speak. Even at $1,997, it'd be a good value, or even at $997. But we have what we call as our early bird discount, $597. That's what it looks like in the order form. cf.altavest.com is the link there. So let me put that in there. .com/TT. And that's going to go, let's see, tf.altavest.com/TT. And you've got my email, and that's my direct phone number there. And it does expire Friday night, so that's why we call it the early bird special. And then it goes back up in price. So there's a 30-day money-back guarantee on that membership. And if something happens in your life and you have to cancel, that's fine. Let us know. We refund that membership, no questions asked. Now, a few FAQs. Tax efficiency. I want to point out that yes, futures and options are tax efficient. So what does that mean? Well, let's not go through all the math, but here's an individual stock trading example where this person has a $7,400 tax liability trading individual stocks. But if you're trading futures and options like we are, in this example, your tax liability is quite a bit less, only $5,360. Tax savings of over $2,000 in this example. And that's because they're treated differently. Your 60% of your gains are taxed at the long-term capital gains rate, which is typically less than your personal rate. So that's the difference. Different IRS tax treatment. No more itemizing as well, but always consult your tax attorney, please. And then 5 advantages on the E-minis. We talked about why we focus on the E-minis. Volume, liquidity. You know, here's just from November of this year, 1.6 million contracts per day on these options that we're trading. So record volumes. Superior execution, that's according to the CME group. The ES options offer a cost savings of $4 to $15 per contract when compared to the SPX options. A tight bid offer spreads. So large market share. This is important. Densely packed strike prices, 100 annual expirations. You get the granularity and coverage. So what does that mean? Well, it means when our algorithm wants to find a strike price, it's going to find it. So here's a call spread, or let's just say calls that you're trading here and puts that you're trading here. And then the algorithm is looking for a series of calls and puts to trade. And that's the next series here, the green. And here's your next blue calls and puts here. So as time goes by, these out of the money calls and puts are available to trade. And that's just because of all of that volume and liquidity. And here's another big advantage on the E-mini trades that we're doing on ThetaTrader with the dragonflies. The way we do it, it's one order placed as one net price, as one trade. There's no legging in to the put side and then legging into the call side, or so on and so forth. Now, if you do this with stocks and try to do a dragonfly, you can't do it as one order. I've tried multiple platforms. I've looked. It doesn't exist. If someone can tell me it exists, that's fine, but I haven't seen it yet. But you have to do it in two separate trades. You have to leg in and out. It's a nightmare, very inefficient. So you have immediate access to these sophisticated option strategies when you're trading with us. Now remember, with the retail stock options trading, they only have access to the most basic call and put option strategies. When you're doing stock options, don't have access to option spreads or other more sophisticated strategies. That's what they call like level 3 and 4 and so on and so forth. So none of that exists with what we do. And don't trade options like a rookie. Don't just buy options because Theta is working against you. And here's that link. You can, if you want to look at that video from that woman, I forgot her name. Oh, there she is, Yoon Lee. She says, why is this popular trading strategy so risky? Well, the appeal for retail investors to just buy options is it's much cheaper, but your potential for profit is not that high. That's because the probability that it works is very low. 2021, 11% of Robinhood's active users made an options trade, and of that, fewer than 1% actually made a multi-leg options trade. So think of that. 11% of them traded options, but only 1% of that 11% were trading option spreads. So that's a lot of people just buying options for home runs. So more advantages. Well, it's easy to track just a couple markets, not thousands. Efficient margin. And then there's a clear cost structure. It's not opaque and in the shadows. Again, we're trading futures options at the CME group. They trade at the Globex electronic exchange. And that means all orders go to the same place and are treated equally. We're not doing this payment for order flow nonsense where your orders get sold and someone else, a third party, fills them at a worse price. Like Robinhood, they say it's free. It's not free. You end up paying more money. You're saving a penny to lose a nickel. It says here they're commission free is what they say, but the customer orders are executed at prices inferior. And that's the same with all of them. Anyone who's claiming customer commission free, it's not free. You're paying for it one way or another. So that doesn't exist with us. Commissions with us are all stated 5.25 round turn, all in. And if you look, for example, online, you'll see places where, well, gee, that looks expensive compared to what I just saw. But here's an example. Website 2.25. Well, that's per side. And they also don't tell you what the clearing and exchange fees are and the NFA fees are, which are required to be paid by the customer. So when you add that all up, it's actually higher than what we charge. So our rates are competitive. And everything is net of all trading, by the way. So everything in ThetaTrader you saw is net of all trading cost. And everyone's performance is different because everyone trades differently, just like any client at any brokerage. And what size of an account? Well, if you want to do dragonflies and condors and other things and have diversification, we recommend $50,000. Each dragonfly is about a $5,000 requirement for margin, just to give you an example. If you want a free membership, people have fun with this all the time. You have a $100,000 account with us, we'll rebate your membership fee, or half of the fee will be rebated if you have a $50,000 account. So make a note of that and take us up on that offer. Any type of trading account, we do IRA as well. the typical individual joint. People do this type of thing all the time. And just to kind of wrap things up, and let me see if I can get a few questions, but why would you even want alternatives in your portfolio? Well, it may improve diversification and lower your portfolio risk. But what is the risk? Well, how about inflation? Still way above the Fed's target. 2-year meat inflation, almost 100% higher. That was interesting. Ron Barron here says the price of everything doubles every 14 to 15 years. I think he's right. Citadel here says inflation is lasting for decades. I mean, look at this. Just from 1978, $1 is now worth 20 cents. So that's why we like alternatives. You have to have your money, working. You want to keep your head above water if you can from the inflation shark. And then also look at this, the leading economic indicator index. Been signaling recession for a bit now. 21st straight month-over-month decline. That's the 22nd month of 24, just barely shorter than the longest streak of declines since the Lehman era, which was June 2007 to April 2008. So, it's continuing to signal underlying weakness in the U.S. economy, a risk of recession ahead, GDP growth to turn negative in Q2 and Q3. That's according to the Conference Board, who actually generates this LEI, Leading Economic Indicator Index. It's showing no signs at all of recovering. So, and then this is an interesting chart. These gray areas here are recessions. And you notice when the index, the blue line, goes below zero and goes negative, there's always a recession that follows. And then here we are right now. So if history is any indicator, it might pay attention. We might, do well to pay attention that we might be in for some rough waters, as much as it might seem like everything is great. Because the stock market, I don't know, is the stock market really doing that great, or is it just 7 stocks? If the Magnificent Seven didn't exist, the S&P would be flat for the year, or not for the year, but for the year, for last year. And like the equal weight S&P 500, if the bigger tech companies, those 7 companies, didn't have all the higher weightings, the equal weight S&P 500 index, it's actually negative. So S&P earnings so far are down 2.5%, 2.4% year over year. And the put call ratio, this is interesting here. Look at this area here, this purple area. So that's the put call ratio back in 2000, just before the tech crash. And what does that mean? Well, that means that nobody's buying puts because everyone's convinced that the market's only going to keep going higher. There's no protection being bought. There's no hedging going on. And here we are getting closer in that same region, actually, where we were in 2000. And meanwhile, you see the NASDAQ just, soaring as if it'll keep going forever. So I don't know. Maybe we need to consider, folks, that things are very, very frothy now. It might make sense to have some alternatives in your back pocket, and ThetaTrader can probably help you with that. And again, why are we looking at just the stock index options rather than individual stock options? Well, an index is always less volatile compared to an individual stock. You can apply strategies for all directions on an index, for portfolio hedging, as well as directional strategies. And then it's easy to track just a couple markets, not 6,000 stocks and ETFs. So again, bull, bear, non-directional strategies available. You don't always have to choose up or down, to try to trade that individual chop and stocks. That's not what we're trying to do. A wide margin of error. Again, looking at the difference between the calls and puts that we're selling oftentimes in ThetaTrader. And then a time saver. Not a lot of us have time to sit in front of a screen like this guy here. 10 to 12 hours of his day is consumed by the market. So it makes sense for us and to you, hopefully, to diversify to alternatives. A lot of non-correlated trading that we can do here. The market doesn't always have to go higher. There's lots of strategies you can apply in different conditions. And we think a portfolio like number 3 makes a lot of sense with that gray piece of the pie there, allocated into something like ThetaTrader. So the automated unique option strategies for speculation or to hedge your portfolio. And there is the link again. ThetaTrader membership includes all of the options software that you saw and the personal coaching along with it. And let me review this real quickly so you know what to expect. You would complete the order form below at that link, this link right here, and then you'll get your ThetaTrader login credentials shortly thereafter. You'll also receive an email with instructions on how to begin opening your trading account. And then once you get the account open and fund it with the money, you begin trading with real money and accepting alerts and placing trades. So you have the algo-driven options trades, various strategies that we saw, and you have that time machine. You can go backwards in time. That's a lot of fun to use. You have those one-touch trade alerts right to your phone. People say, I'm in the supermarket, I'm in line, I'm at my kid's soccer game. They just, it's kind of fun to hear where everybody is. Those trade alerts appear on your dashboard as well in the software, not just on your phone. And then you just click the view it and touch it and accept it right there. That's how you do it on the dashboard if you have using the dashboard. So again, here's that offer, $597. That's a lifetime membership. And let me see if I can get in a couple questions. Yeah, phone number there, 949-236-6961. That's my direct line. There's my ERIK@altivest.com. And then let's see here, someone's talking about credit spreads. Yeah, that's right. I mean, credit spreads do generate a smaller profit potential compared to long option positions, which have sometimes, much larger potential. Absolutely. So it's just you're flipping things upside down. Let's take a look here at more questions. And someone said they couldn't hear. Sorry about that. I know that everyone else has been hearing me. Otherwise, I would have seen and heard about it. Yeah, and the trading account size, it's really up to you, but 50,000, 25,000 is probably a minimum. But let us know what you have in mind. So thanks for the question there. And let's see if there's anything else coming in. Any other questions? Let me put my number and email in the chat. And you've got the link for the membership form there already. And there's my phone number. That's my direct line. Of course, give it a call anytime if it doesn't pick up. I'm either doing a webinar like this, and of course, this is live right now, or someone else will pick up the phone, or it'll go to my voicemail. So that's fine. Any other questions, folks? All right, very good. Well, I think this has been a great demo, hopefully, for some of you. I always have fun. So thank you for showing up, and we will have a recording out to you shortly. But in the meantime, you're welcome to call me with any comments or questions. And there's a survey that gets emailed as well. So I'd appreciate any feedback on the survey, good, bad, or otherwise. And yeah, there is a recording. Thanks for the question. So we'll get that out shortly, probably, hopefully later today. But maybe you had some questions. You've got me here for a few more minutes. If you want to go ahead and ask a question, you can. I'll keep an eye on the questions field here. Okay, that's good. I think we'll wrap it up. I don't want to keep everyone here and longer than we need to be. And I think we've covered a lot of ground. So we will wrap it up. We'll talk to you soon and have a great rest of the day. All right. Oh, one more question here, just as I'm signing off. You're here. Yeah, give us a call depending on what you have in mind for your trading account and the size of it and what type of account, if it's an IRA or joint or individual trust, whatever it is. Give us a ring. We'll see what we can help you with. And thanks for the questions and comments. Have a good day, everyone. Bye-bye.